Welcome to Rapid Fire Crypto Rundown. Today we're diving into this recent Milk Road newsletter. It's got everyone buzzing about this potential 30% pullback in the crypto market. And they're basing this prediction on some pretty compelling evidence. Specifically this chart comparing global liquidity to Bitcoin's price. Okay, so help me out here. This chart, it's a bit complex.
It's fascinating. What Milk Road is highlighting here is the relationship between global liquidity, basically the amount of money flowing through the financial system, and how it tends to precede movements in Bitcoin's price. And what's remarkable is they're seeing a consistent lead time of about 12 weeks.
So if global liquidity increases, 12 weeks later, Bitcoin tends to follow suit.
You got it, and vice versa. A decrease in global liquidity often foreshadows a dip in Bitcoin's price about 12 weeks down the line.
And the newsletter claims that the chart has been pretty accurate historically.
That's what's really catching people's attention. They're showing how this relationship played out in the past and using it to predict what might happen in the next few months. For example, remember that recent Bitcoin rally we saw? Well, according to Milk Road's chart, that rally was preceded by an increase in global liquidity, right on schedule.
Okay, so the chart has some credibility, but why are they predicting a pullback in NOW?
Here's where it gets interesting. Milk Road is pointing to recent data showing a decline in global liquidity over the past few weeks. And if their theory holds true, that could signal a significant dip in Bitcoin's price in the near future, hence the prediction of a potential 30% pullback.
All right, that makes sense. But I need to understand this better. What exactly is global liquidity, and why does it have such a big impact on crypto? It feels like something from an economics textbook.
It's actually simpler than it sounds. Think of it this way. Imagine the global financial system is like a giant swimming pool. When there's a lot of liquidity, it's like the pool is filled to the brim with cash. Investors have more money to spend, they're feeling bullish, and they're more likely to take risks on assets like crypto, pushing prices higher.
Okay, I can picture that. So when global liquidity decreases, it's like someone pulled the plug on the pool, and everyone's scrambling for the remaining cash.
Exactly. Suddenly, investors are less willing to take risks. They might sell off their assets, including crypto, to shore up their cash reserves. And that selling pressure can drive prices down.
So following Milk Road's logic, this declining liquidity could be a sign that the easy money party in crypto is winding down.
That's the concern. But it's important to remember that crypto isn't the only asset class affected by global liquidity. It impacts stock markets, real estate, commodities, everything. What's interesting is that crypto, with its 24/7 trading and global accessibility, is often seen as a leading indicator. It's kind of like the canary in the coal mine for the broader financial system.
So what you're saying is, if crypto starts to dip because of reduced global liquidity, it could be a sign that other markets are headed for trouble too.
Potentially, yes. It's not a perfect correlation, but it's definitely something to keep an eye on. Now, understanding how global liquidity works is crucial, but it begs the question, what factors actually cause these shifts in liquidity in the first place? That's where we need to look at the broader macroeconomic landscape.
The dreaded macro word. I have a feeling this is where things start to get really complex.
It can be a bit daunting, but don't worry, we'll break it down in a way that's easy to understand. Essentially, there are several key macroeconomic factors that influence global liquidity.
All right, let's tackle these macro factors. What are we talking about here? And how do they impact global liquidity?
Well, one of the biggest culprits is inflation. You know, when the cost of everything from groceries to gas keeps creeping up?
Yeah, definitely noticed that at the pump lately.
Exactly. When inflation is high, central banks, those institutions that control a country's money supply, typically raise interest rates to try and cool things down.
So how does raising interest rates help with inflation? And what does this have to do with global liquidity?
Think of it like this. Higher interest rates make it more expensive to borrow money. This discourages businesses from taking out loans for expansion, and consumers from racking up credit card debt. It slows down spending, which helps to curb demand, and in theory, bring inflation under control.
Okay, I'm starting to see the connection here. Less borrowing means less money circulating in the economy, which means less liquidity.
Precisely. And this tightening of monetary policy, as it's called, can have a ripple effect throughout the financial system, impacting everything from stock markets to, you guessed it, crypto.
Got it. So inflation's a big one. What other macro factors are we watching?
Another key factor is the strength of the U.S. dollar. Remember how we talked about the U.S. dollar being the world's reserve currency?
Yeah, like the global gold standard.
Exactly. When the U.S. dollar is strong, it means other currencies are relatively weak. And this can have a knock-on effect on global liquidity.
But wait, wouldn't a strong dollar actually benefit U.S. investors, giving them more purchasing power to buy things like crypto?
That's a great question, and it's where things get a bit nuanced. While a strong dollar might seem good on the surface, it can actually make things more expensive for other countries to import goods and services. This can lead to economic slowdowns in those countries, which can then impact the global economy as a whole.
Ah, I see. So even though U.S. investors might have more buying power, the overall global economic slowdown could end up hurting everyone, including crypto.
Precisely. It's all interconnected. Now, Milk Road also highlighted a third macro factor that can impact liquidity: overall economic activity.
So are we talking boom times versus recession?
You got it. When businesses are booming, people are spending money, and the economy is growing, there's usually more liquidity in the system. It's like everyone at the party is getting paid. But when economic activity slows down, businesses pull back on investments, people tighten their budgets, and liquidity dries up. It's like the party's over, and everyone's heading home early.
Makes sense. So we've got inflation, a strong U.S. dollar, and a potential economic slowdown, all factors that could contribute to reduced global liquidity. Am I missing anything?
Well, Milk Road also briefly touched on two more factors: geopolitical instability in the yield curve, global conflicts, trade wars, and political uncertainty can all create economic volatility and impact liquidity.
Yeah, those black swan events can really throw a wrench in the works. What about this yield curve thing? That sounds pretty technical.
It is a bit complex, but I'll try to explain it simply. The yield curve is basically a graph that shows the difference between short-term and long-term interest rates. Typically, long-term rates are higher than short-term rates because lenders expect to be compensated for tying up their money for longer periods. However, when investors get nervous about the future of the economy, they sometimes pile into long-term bonds, driving down their yields. This can cause the yield curve to invert, meaning short-term rates are higher than long-term rates.
So an inverted yield curve is a bad sign.
Historically, yes. An inverted yield curve has often been a precursor to recessions. It's like a warning signal that investors are worried about the future. And when investors get worried, they tend to pull back from risky assets like crypto.
Okay, so we've got a lot of potential red flags here. Inflation, a strong dollar slowing economic growth, geopolitical risks, and a potentially inverted yield curve. It sounds like Milk Road is painting a pretty gloomy picture.
Well, it's important to remember that macroeconomics is complex and ever-changing. These are just a few of the many factors that could impact the crypto market. And it's not all doom and gloom. Remember, in part 1, we discussed how Milk Road also highlighted some positive developments happening within the crypto industry itself.
You're right. We can't forget about those. Things like increasing stablecoin adoption, new ETF applications, and even Trump's pro-crypto stance could help to offset some of these macro headwinds.
Exactly. It's a fascinating tug of war between these forces. So how do we make sense of it all? How do we, as investors, navigate this complex landscape and make informed decisions?
It feels like we're standing at a crossroads here, with all these different signals flashing. On one hand, we have these macroeconomic storm clouds gathering, but on the other, there's this sense of excitement and innovation within the crypto industry itself. How do we reconcile these two narratives?
That's the million-dollar question, and honestly, there's no easy answer. But I think Milk Road does a good job of highlighting some of the bullish factors that could potentially counteract those macroeconomic headwinds.
Let's dig into those.
Yeah.
I need some optimism after that deep dive into macroeconomics. What specifically are they pointing to?
Well, one major trend they highlight is the explosive growth of stablecoins. Remember, these are cryptocurrencies pegged to the value of a stable asset, like the US dollar. They offer the benefits of crypto, like fast, borderless transactions, without the wild price swings.
Right, so they're kind of like a gateway drug to crypto for people who are still wary of volatility.
Exactly. And what's interesting is that stablecoin adoption is happening at an unprecedented rate. It suggests that more and more people are finding practical uses for crypto in their everyday lives. This underlying growth in adoption could be a powerful counterforce if the macro environment weakens.
So even if Bitcoin's price takes a hit due to global liquidity, the increasing utility of stablecoins could provide a floor for the overall crypto market.
That's one possible scenario. It's like a separate engine driving growth within the crypto ecosystem, even if the speculative trading side takes a breather.
Okay, that makes me feel a bit better. What other bullish factors did Milk Road mention?
They also pointed to the surge in ETF applications. These are exchange-traded funds that hold a basket of assets, making it easier for institutional investors to get exposure to crypto.
I've heard a lot about ETFs, but haven't really wrapped my head around them. Why is everyone so excited about them?
Well, for one, they offer a familiar and regulated way for big players, like pension funds and hedge funds, to enter the crypto market. Right now, many institutional investors are hesitant to invest directly in crypto. Because of regulatory uncertainty and the lack of established custodial solutions, ETFs could help to bridge that gap.
So more ETFs can mean a flood of institutional money pouring into crypto.
Potentially, yes, and that could have a huge impact on prices. Think about it. Even a small percentage of institutional assets flowing into crypto would represent billions, if not trillions of dollars. That kind of demand could easily outweigh any short-term selling pressure caused by macro factors.
Wow. I hadn't thought about it like that. That's a really compelling argument. It seems like Moth Road is presenting two possible futures. One where macro forces dominate and lead to a pullback, and another where institutional adoption through ETFs fuels a continued bull run.
Exactly. And what's fascinating is that both scenarios could play out simultaneously. We could see a short-term dip driven by macro factors, followed by a surge as institutional money starts to flow in.
So it's not necessarily an either-or situation.
Right. It's more like a dance between these different forces. And as investors, our job is to try to understand the steps and predict the rhythm.
Okay, so we've covered stablecoins and ETFs. Anything else we should be paying attention to?
Well, Milk Road also touched on something that could be a real wild card: Trump's pro-crypto stance.
I remember they mentioned something about a national strategic Bitcoin reserve. Is that actually a thing?
It's still just an idea at this point, but it's definitely generating a lot of buzz. The concept is that the U.S. government would hold Bitcoin as part of its national reserves, similar to how it holds gold.
A Bitcoin reserve. That's a pretty bold move. But I'm curious, how would that even work in practice? And wouldn't it be risky for a government to hold such a volatile asset?
Those are valid questions, and
Yeah.
the details are still very much up in the air. But the fact that it's even being discussed at a national level is significant. It suggests that governments are starting to take crypto seriously, not just as a speculative asset, but as a potential store of value and even a strategic asset.
It would definitely be a game changer if the U.S. government started buying Bitcoin. It would lend a lot of legitimacy to the entire crypto space.
Absolutely. And it could potentially spark a global trend. With other countries following suit, imagine a world where central banks are holding Bitcoin alongside gold and other traditional reserve assets. That would be a seismic shift in the global financial system.
Okay, so we've got a lot to think about here. Stablecoin adoption, new ETFs, government involvement in crypto. It feels like we're on the verge of a whole new era for the crypto market.
I agree. And while there are definitely some challenges ahead, especially in the short term with these macro concerns, the long-term potential of crypto seems brighter than ever.
So what's the key takeaway for our listeners? What should they be doing right now to navigate this complex landscape?
I think the most important thing is to stay informed and to think critically. Don't blindly follow the hype or panic sell based on headlines. Do your research, understand the forces at play, and make informed decisions based on your own individual risk tolerance and investment goals.
Great advice. And don't forget, knowledge is power. Keep learning, keep exploring, and stay ahead of the curve by checking out resources like the Milk Road newsletter. The link is in the description.
It's a fantastic way to stay up to date on all the latest developments in the crypto world.
Thanks for joining us for this deep dive into the potential crypto pullback. Until next time, stay curious and keep diving deep.